Welcome back, everyone. Thank you so much for joining me today. If you're new, take a minute now to subscribe and follow my work at worldaffairsandcontext.com. I would love to see you there. Every week I publish a newsletter with the week's top headlines, including the video that I uploaded during the week here on my channel, and the most important events in economics and geopolitics for that week. It is a newsletter that you can easily subscribe to. There is absolutely no charge for it, and it will be delivered to your mailbox every Saturday morning. This week I shared very concerning trends that point to stagflation ahead. Consumer confidence in April just hit yet another low. Just when we thought that it can't get any worse, it actually did. U.S. housing market is expected to slow even further, and the manufacturing index drops even lower. To top it off, the World Trade Organization predicts global trade to slow, and that will have a profound impact on everyone. So with that, let me share the specifics with you. Let's start with the U.S. consumer sentiment. You may recall that last month when I shared the update, I said that the reading in March dropped to an all-time low and it probably cannot get any worse. Well, I was wrong. It actually did get worse. In April, consumer sentiment plunged to 50.8, the second lowest on record and the steepest decline since the early 1990s recession. It is driven by worsening views on current conditions and future expectations. This marks a 4-month, 31% decline, bringing sentiment to crisis levels not seen since the early 1980s. Why is consumer sentiment important, you may ask? Well, isn't this just an opinion and why should I care? Well, let me explain. Consumer sentiment is the heartbeat of the economy. When confidence soars, people go out and spend, they invest, and they drive growth. When it crashes, like it is now, fear grips markets, businesses pull back, and recessions loom. It's not just an opinion, it's a powerful signal that can trigger booms or busts. One shift in sentiment can send shockwaves through stock markets, through the housing market, and of course through global trade. In short, how people feel today shapes what the economy becomes tomorrow, and we now stand at the second lowest point on record. What's driving U.S. population to have so much fear in their economy? Well, this sharp drop is primarily attributable to escalating inflation fears, as well as the economic uncertainty that results from President Trump's aggressive trade policies, including sweeping tariffs on imports from China, from Canada, and from Mexico, and overall uncertainty in global markets. These tariffs have led to increased prices on everyday goods, and they also made consumers anticipate higher costs moving forward and even potential job losses. So additionally to that, the political volatility that surrounds these trade decisions has completely eroded public confidence in economic stability. Therefore, the reading is at an all-time low, and we'll see where it stands in May. I'm looking forward to seeing whether this trend continues. Next, let's chat about manufacturing, since it has been in the news along with tariffs. Consumers are not happy? Well, let's see if the manufacturing in the United States shows any improvement. Unfortunately, it too shows signs of deterioration. The New York State Manufacturing Index dropped to negative 8.1 in April, with future business and new order outlooks hitting historic lows, the kind of lows that we haven't even seen during the 2008 crisis. At the same time, price expectations surged to their highest since 2022. As I mentioned in my post on Substack, this data signals growing fears of stagflation, and that is true across the board, across all states in the US. The contraction in manufacturing sector is not something that can improve overnight. This is the product of months of failed policies, and of course they didn't begin in January, so we have to be honest. This decline is attributed to several factors, however, such as The first one that I want to mention is, of course, the trade policy uncertainty, because that has been driving the markets since early March. Ongoing trade tensions and the implementation of tariffs have increased costs and disrupted supply chains, leading to reduced manufacturing activity. Additionally, input costs have also been on the rise. Manufacturers are facing higher prices for raw materials, which have eroded profit margins for many companies and also dampened production levels. And the third reason for the weakening manufacturing index here in the US, I would mention softening demand. A slowdown in both domestic and international demand for manufactured goods has contributed to the negative index reading. By the way, this is the first negative reading since early 2023. So far, we've covered deterioration in consumer expectations and a decline in manufacturing index. Those two readings are crucial for understanding broader economic stability in the country. Now, I want to quickly touch upon the U.S. housing market, because with the housing affordability crisis in the United States increasing, it's one of those topics that I know many of my viewers are very much concerned with. The U.S. home price growth is expected to drop significantly in 2025. After a 4.5% rise in the first quarter of this year, growth is projected to slow to just 1% by the end of the fourth quarter. This is the slowest quarterly rate in 6 years. Full-year growth is forecasted at 1.8%, the weakest growth since 2011. The U.S. housing market is expected to slow in 2025 due to several key factors, and I just want to take a couple of minutes to explain why it is expected to slow. I'll mention the top 4 reasons today. First, we've got elevated mortgage rates. Despite modest declines, mortgage rates remain above 6%, which makes homeownership less affordable, and also it deters potential buyers. The second reason I want to bring up is, of course, the affordability challenge. High home prices coupled with rising interest rates continue to strain buyers' budgets, which in turn leads to decreased demand in the housing market. The third factor here are supply constraints. The lock-in effect persists. Many homeowners are hesitant to sell, and it limits inventory of homes for sale. Lastly, it's the trade policy uncertainty, and I know I've brought it up several times, but this is how important it is. Ongoing trade tensions and tariffs have actually increased construction costs, which is, of course, that input cost, because the input costs have increased, and it further impacted housing affordability and slowed new home construction. So these factors combined are contributing to a projected slowdown in the housing market for 2025. As you can tell, the 3 key readings that we just covered are very much related, and they're driven by policy choices as well as a myriad of other factors that together have a negative impact on the economic outlook, to the point where the rising inflation and the slowing economy are now flashing red, and stagflation is becoming a likely scenario moving forward. So I will go ahead and wrap this up before the video gets too long. If you want to receive free weekly updates, head over to worldaffairsandcontext.com, become a subscriber, and I will help you stay up to date. Thank you very much for watching. I hope this quick video was helpful and insightful. If you found this helpful, make sure that you drop a like and also subscribe to my channel, and I will see you in the next video. Bye for now.